All attendees are in listen-only mode.
Good afternoon, everyone. My name is Matt Doffing, and I work here at the Core Point with Neil as Marketing Director. I'm standing in for Julie today. She wanted to be here, but she's out sick. We want to welcome you to the first webinar we've offered on this experience enhancement to the traditional CD. With banking's combined certificate volume now standing at $3.5 trillion, many institutions originated term deposits during a high rate environment, and many of those deposits will take some time to mature. So what can your institution do to save on those deposit costs and remain differentiated in depositors' eyes? That's why we wanted to talk to you today about a novel approach to reducing certificate interest expense. We're excited to get started, but just two quick housekeeping items before we do. We will share the recording, the slides, the resource documents with you through the email you provided during registration. Look for those in your inbox next week. If you'd like to access any of them during the presentation, though, they are in the Handouts tab. We also have prepared summaries about this type of deposit opportunity for each of your institutions. So if you'd like to receive one, just let me know in the webinar chat, and we'll send you one by the end of next week. For questions, you will be able to do a Q&A with Neil at the end. You can put those into us through the right-hand menu in GoToWebinar. It's the Questions tab. We wanted to see if you'd test that system with us just quickly. Let us know what's the temperature where you are right now in the Questions tab.
I see a sunny, wow, sunny and 50s.
So everywhere is warmer than where I am. Nice. Okay, that's great. So you can use that same tab. We will, as I said, have a questionnaire at the end. We have ample time for that, but Neil's also said he'd be happy to take questions during his presentation. So just let me know if you have one and I'll interrupt him. With that, you all know the presenter. Take it away, Neil.
Thank you, Matt. It's great to be with you all here today. I can't tell you how excited I am about this topic. I've been working on this for many, many decades. And I said decades, not years. So the enhanced term deposit offers, we recently did a story in the Financial Brand on this topic. And you can see it there. Rethink early withdrawal penalties to create a win-win for financial institutions and their customers. So this is all about the redeemable CD. The redeemable. Sometimes we call it different things, but we're talking about the opportunity to move beyond the historic approach to time deposits, which is really arcane. It was designed in the 60s. I said 60s, or we didn't have any calculators. None of you were in the business back then. So as Matt said, you all know me. You're all clients on this call. We decided that we wanted to do an exclusive client-only introduction for this very, what we think is going to be very important in 2025, and that is the redeemable CD. So we're going to go beyond the traditional time deposit. That doesn't mean we're getting rid of the traditional time deposit. We know that CD customers are some of the most conservative people in the world. They do not want their world rocked. They do not want change. They are risk averse. We get that completely. We're not asking you to do away with the traditional certificate or CD. But what we want to do is help you with what you want and enhance your offerings. And we're going to show you a sample of the opportunities. And as Matt said, we definitely want some Q&A activity here. So Matt's going to be watching. And I welcome you to stop me in the process. You do not need to wait until we get down to the end for a conversation. So all of you have produced statements and online and mobile banking reports to the long-term saver. And it often looks something like this. Here's your rate, your APY, your interest earned, and your interest paid year to date. And of course, the maturity date. But you're not really telling people if they cash out today, what's it worth? Most human beings today think that they're going to go online somewhere and find out what's my investment worth today. All you're telling them is the current principal and accrued interest. So what you really want, you want all the funding you can get at the lowest possible cost. Whether you're a bank or a credit union, we all think the same way. And the reason being is the lower we can fund the financial institution with expense, the greater opportunity is to serve borrowers and be able to do that profitably. So call report data from banks tell us that the average CD in the fourth quarter was 4.43%. So on $2.9 trillion of funding, we spent $130 billion on interest expense as an industry. If you annualize that, it's 4.43. That means there are lots of accounts out there that are over Fed funds. They are over the marginal revenue that you're going to get at the financial institution. We know the history has been one of significant change when it comes to certificates. Back in 22, the banking industry had 1.2 trillion of CDs. And there was no time that I would have heard a bank executive say, we want to be really big in CDs. No, CDs are the most expensive way to fund the bank. We're not trying to explode CD volume. What we're trying to do is get all the deposits we need at the lowest possible cost. So why is it then that we've increased that volume of bank accounts to $3 trillion? Well, there's a good reason. Instead of repricing all of our non-maturing deposits, as Fed funds went up, we said, I know, let's not change our savings. Let's offer CDs. Now, the depositor is going to have to compromise their liquidity. They're going to have to lock up their money for a period of time. And if they're willing to do that, we're going to give them a rate that's pretty close to Fed funds. So we went from 1.2 to $3.3 trillion. It's actually more like 3.5 if you look at all the credit union balances as well. But this happened in spite of the fact that bankers didn't want CDs and depositors didn't want to lock up their money. But we compromised in order to come up with a situation where we didn't have to reprice all of our short-term funds. Now, as you all know, you've ridden this ride. Interest rates were very low. This is the 6 and 12-month FHLB advance rate going back to 2010. It was very low. It started to go up, and then it went down in the pandemic. And then it rose to the mid-5s last year. And now it's in the mid-4s. This is why you're hearing about this from us today. We prepared for this environment decades ago. And what I mean by that is back 30 years ago, I looked at this and I said, bankers are missing the boat. They are selling CDs like it's 1960. We should use the computer power we have and market value an early redemption. Nobody ever did. So in 2012, I patented the process of market valuing a bank or credit union CD for early redemption. Yes, the US Patent Office checked to see, has anyone ever done this? And there was no evidence that anyone in the United States had ever done this. Now, it's not regulatory restriction because the regulators simply say in the first 6 days of opening the account or of a partial withdrawal, you have to charge at least 7 days of interest. Other than that, you can do whatever you want. You can charge a no penalty, big penalty, or you can pay a bonus. That's what we're talking about today. And interest rates have fallen. Here we have FHLB advance rates towards the end of the year. But if you can fund those accounts cheaper than what they're on the books at right now with either wholesale or retail deposits, do you really want to keep paying 5 something? The benefit can be even greater than what you're going to reward the depositor. In other words, you may want to pay a bonus for early withdrawal, and in the process, you're going to make money. It's not like you're giving away the store. So let me show you how this is done, and we'll work specifically with an example using the actual calculator, but we put it in the document, so it's in your deck. If you had a situation where there's 12 months remaining, $100,000 deal, and maybe there's an accrued interest of 50 bucks. If the interest rate's 5% on that, then we know it's going to be worth $105,052.50 at maturity 12 months from now. But wait, there's more. We don't stop there. What if we wanted to do this today? What if, because it's 5% and we could actually get the funding more like 420, what if we, as the finance team, said, I'll tell you what, we're going to calculate the present value of that cash flow at 478. Now, I said we could replace it at 420 here at the bank, but at 478, we're going to give a bonus. We calculate the present value of that cash flow, and we find out that we could pay a $210.07 bonus. Now, we're not telling the depositor they need to do anything. We're telling them here at our financial institution, we understand that it's their money. And if we have an opportunity to help them get their money back sooner, we want them to know that it's available to them. So if they want, they can take a bonus for early withdrawal. Now, we're going to show you some math here, but I want you to stop for just a moment because many of you are going, wow, bonuses for early withdrawal. We're trying to get rid of deposits. No, 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 no. When somebody experiences something that they didn't expect that's super positive, hey, bonuses are not expected, and it's a positive for me as a depositor, not a negative. They do not close out their account and walk away, never look back. No, no, no. In fact, once they find out about this, they go, well, maybe everybody does this. I'm going to see if other people do this. No, this is unique. This is unusual. It's special. And it's offered through your financial institution that you offer bonuses anytime interest rates fall, that there's a possibility of a bonus. So your online banking system could feed this right into their online or mobile banking, and it could pop up, there's a bonus for early withdrawal. Doesn't make any sense to pop up, there's a penalty to initiate a penalty. But if you want to initiate good news, initiate, there's a bonus for early withdrawal. It enables you to set the discount rate. We are not giving up control, folks. This is not about giving the depositor an open access to the vault and just telling them, go take what you want. This is setting your finance team up so they can say, hey, wouldn't it be better off if we let that deposit go? Because we're positioned to control the price at which we set that bonus. And let me show you really quickly what this might look like on a little spreadsheet. Yes, I'm analytics, so I like spreadsheets. What if we took a $100,000 deal that's booked at 5%? If that's the case, we could go in and say, well, if today the wholesale replacement cost would be this, or it could be a retail, but wholesale, we know without a shadow of a doubt, we can get millions of dollars at these rates. As the rates go down, we know the present value of that $105,000 a year from now is going to go up, right? Because we don't have to pay as much in terms of funding it today. So if it drops 100 basis points, there's $1,000 difference, but present valued, that's $961.54. Oh, okay. So as rates go down, we see an unrealized gain potential for the depositor. Anyone in your bank or credit union that's managing the investment portfolio goes, yeah, that's how our securities portfolio works. Folks, we have not invented any new math here. We're using the math that your financial institution has used for decades to manage their investment portfolio. Now, you get to keep a spread. There's nothing that says how you have to price this. So if interest rates fall 100 basis points, maybe you take 35 basis points of that difference. So instead of giving them a $961.54 bonus, you tell them, we'll pay you $622.90, and we get to keep here at the financial institution the benefit of getting out of 5% and instead funding at a rate of 4% and keeping that 35 basis point spread, which present value is $338. So these things are patented and trademarked. You can use these tools from us to present a surprise benefit to your depositors. Once the surprise benefit has been introduced, you may want to go beyond that and say, it's not just about the bonuses today. We are in the process of revitalizing long-term savings in banks and credit unions. And by doing that, we're offering the redeemable, not just in the event of a bonus, but we'll sell the original certificate as a redeemable. You don't have to buy the traditional CD with an early withdrawal penalty. It provides value similar to fixed income securities, and it improves the depositor experience as it communicates that we get them. We understand they want two things: high yield and short commitment. So why not offer these benefits as you originate? Now, I'm going to tell you, I fully appreciate that you don't take a typical CD customer and say, hey, we're going to send you a new disclosure and we're going to change the terms and conditions of your account. Don't do that. Don't stop offering traditional CDs. But for the shopper and the curious, now you have more ammo. You have more tools in your toolkit, because now you have a sweetener that you can take a traditional CD and say, well, we could turn that into a redeemable, which looks really, really compelling. So let's tee these up in what might look like a marketing promotion. Somebody could say, hey, we have a high yield savings account, typical savings account. We have a typical CD, or we have the redeemable, which kind of provides a little bit of benefit of both the savings account and the traditional CD. It works just like a CD, exactly like a CD, no fancy stuff, other than if you want early withdrawal. If you want early withdrawal, you're going to get an ability to calculate every day what the market value is. You're going to have the ability to pull out money at that valuation. And you will never, ever have an early withdrawal that is worse or lower value than traditional CD. We learned that you need to give the CD shopper the understanding that if you take a traditional CD, you're going to have our penalty. And if you do the redeemable, it will never be a penalty or a fee greater than the traditional CD penalty. That puts them at ease. And that allows you to sweeten the liquidity without raising the price. In fact, as this becomes ubiquitous, you're going to find that you're going to be able to lower the interest rate for this improved process. But don't start off with that, because the depositor hasn't experienced it yet. You have to let them get the same interest rate, whether they open traditional or redeemable. And as they become familiar with the redeemable, then they will see value in it and they will associate a point spread for that. So the redeemable advantages, folks, it's just like any other CD if held to maturity. We're not creating any new technology here. We're not creating any hardship on your core. It's a simple CD. But every day the depositor can easily find today's cash value. That's really hard to do with the classic or traditional CD. If interest rates decline during the holding period, an early withdrawal would pay a bonus. And under no circumstances, the early withdrawal value less than the classic CD. There's more information on our website that you can get on this. But now for you, this is the sweet part. Because you're fixing the flaw, there's a flaw in your CD. That is the early withdrawal penalty. It has nothing to do typically with the damage it does to your bank from early withdrawal. So you're giving up nothing if you continuously set the discount rate to determine the early withdrawal penalty. The financial institution gets more value by having accounts that got rid of the flaw, and depositors are going to see you as the hero of the story. And it is patented. I told you that we started thinking about a patent over 20 years ago. We filed for it in 12. Our patent will be good until 2032. So anyone who uses this process without licensing it through us is going to get a notice from our attorneys to cease and desist. But for you, you're all clients. You already have a Core CD subscription. I'm going to show you in a moment how we can upgrade that subscription so you qualify for this patented process. This has been written about, as I told you, as we started the financial brand story recently, but BAI did a really nice job, and you can see a link there in the document that is in the handout that you can go look at this topic, and you can see an article about how we predicted years ago that this was going to become a material improvement for both banks and depositors as people see the opportunity for daily redemption options. So I did run this through AI, gave it some information about it, basically put this information into Perplexity or ChatGPT, and ChatGPT came back and said, From a purely rational standpoint, now we know every depositor is not rational, but from a purely rational standpoint, the informed depositor would rarely, if ever, select a standard CD over a market value or redeemable CD. We can use those terms interchangeably, redeemable, market value. Assuming the features you have described what I've described to you today. However, behavioral factors like familiarity, perceived simplicity, or lack of product availability might still lead to the selection of a standard CD. That's why we don't do away with the traditional CD. But if financial institutions like you all at the forefront make redeemable / market value CDs more widely available and educate consumers about their benefits, these products could become the preferred choice for informed savers. So I'm going to give you a sample here of some current opportunities. I'm going to use my Excel document here and show you some things that are going on here. So let me pull this up. Each one of you provides to us at the end of a month, you send in your CD portfolio. We have taken those portfolios. This is not any one particular portfolio. It's kind of an amalgamation of portfolios. As of end of January, there was $605 million. The average yield was 4.39. So 4.39 average portfolio yield. We looked at the potential of dropping in all the data you sent us and then calculating how much time to maturity. What would the future value be at 5%? What's that going to cost your financial institution? And if in today's discount rate, and we took the FHLB rates and we said, okay, if we could replace those funds for FHLB, which you can all test or evaluate on your own, and then we added a 20 basis point spread so that the bank made 20 basis points on every one of them, then that discount rate gets in here and we present value that cash flow at the discount rate that includes our profit. So in other words, we're going to keep some profit for the financial institution. We would, in this case, a $300,000 deal, offer that depositor $6,040.75 if they wanted to cash out early. As I said earlier on, this is not a plan to reduce deposits. It's actually a plan to grow deposits. But you are telling a story about good news on their specific account. Now, if they were to cash out, the bank would make an extra $2,081.48. Now, these numbers are all arranged by your finance team. There is nothing set by us. It's up to you how you want to price. Just like it's up to you how you price the issuance of new CDs, it's still up to you as to how you price the redemption of redeemable CDs. But we're just doing a case study here of if we discount at 441, but we could actually get the funds at 421, we would make $2,081 of profit, and the depositor would get a $6,040 bonus. We did that for every certificate in this particular portfolio, and then we sorted it by bonus. So you can see as we go down, there's still a lot of CDs that have substantial bonus opportunities. The higher the expense of the portfolio, the more bonus opportunities there are. So those of you that have a super low cost of funds, probably going to have fewer bonus opportunities. That doesn't reduce the need or the benefit of telling your deposit base about this new approach that gives them nothing but benefit. If every one of this particular financial institution, there are 2,467 that qualified for a positive bonus. If everyone did that, the bonus total would be 448,000, and the bank would make an additional 236,000. Now, that's not going to happen. You're not going to have $212 million of early withdrawal. You might have 10 million. You might have 6 million. We don't know exactly. But if you get more withdrawals than you want, you just change the pricing so it's not as profitable for them to do so. And we can show you here in a little quick analysis, if you want to take more spread, you're going to reduce the volume that qualify for bonuses. You're going to increase your profit until you start to decrease the profit. you're taking bigger spreads of smaller volumes, and at some point, there's no profit to be had. So this analysis we do for each of you. We can give you a very thorough evaluation of what this might look like. And we can test then, what if interest rates fall from here? And we go in and we substitute what would a lower interest rate environment do? And when it runs the numbers, it's going to come back and tell us, wow, if rates go down, we're going to make even more money. There's going to be more bonuses available and more profit available. These are all the kinds of things that we can do using this very simple spreadsheet. Now, when I say simple, I want you to know that I know some of you are on this going, wow, this is a lot of present value calculation. There's a lot of math involved. I understand that. But this is not any math that would be foreign to somebody managing an investment portfolio. Everything we're doing here, if somebody in your bank is managing an investment portfolio of fixed income securities, they're doing all of this. They understand all of this. So your front line does not need to be experts at every aspect of discounting a cash flow. So with that, I'm going to switch over to kind of some summary data. This is all of you. So we have in this deck, we have 50 financial institutions, and we sorted them based upon the ratio of positive bonuses to, the profit, it's D, positive bonus, to C, which is those available for bonus. So this is just calculating the financial institutions that are the highest rates. So some financial institution in our group had $200 million that would qualify for a bonus. Of that, the bonuses would total $1 million. But if they did do all of those, the bank would make an extra $469,000. So these are up here at the top are the most substantial. We will be sending these out, as Matt said, to you. You won't see this ranking necessarily, but you will see if whoever's numbers are individual line item here, you'll see these numbers for your organization. And from this, then, we can produce a summary of the redeemable opportunity. So if you had 1,606 CDs in the portfolio, total dollars in the portfolio, the number available for bonus, given the assumptions. Of course, you set the actual pricing. This just gives you a template in which to start to work with this and the amount of profit for the financial institution. So you can see here the profit's highly variable. Some financial institutions have very little profit. Like this financial institution is probably not going to be interested because the whole portfolio, there would only be $1,650 worth of bonuses under today's rates. Now, if rates continue to go down, there may be more. This financial institution has a super low cost of funds, and so they just don't really have any CDs that would qualify. On this other case, this one has a relatively high cost of funds, and they may be interested in lowering their costs. If so, these are the numbers appropriate for them. You are not homogeneous. There's a huge variety, and you only know what you're eligible for by running the numbers and taking a look at those. So I'm looking here. Matt, have there been any questions come in so far?
Yeah, one's fairly long, so I'll just summarize it here. So you've presented a opportunity to look at early withdrawal penalties in a different way. But what Neil, if you were running the deposit strategy at an institution right now, what's the very tip of the spear thing that you would do with this?
Yeah. So the first thing I would start with is a data analysis where we would take this data for your bank, and we would look at who this is, who owns that. And before we did any major thing, we would as an executive team go, guys, what do you think? If we were to reach out to that person and offer a bonus, what do you think would happen? Then we would actually test it. We would reach out to them and say, hey, we're not expecting anything here, but we want you to know that it would be, if it was in your best interest, we would consider in our best interest to offer you a bonus of $6,040. And if you do this and they respond positively, whether it's positive, hey, that's a great idea, but we're not going to do it because we don't really need the money. And what would we have to reinvest it at? Well, they would have to reinvest it at a rate of 441 or better. That's what we're calculating. You know what it is. That's what that would be. You can tell them that, or you can decide how you want to handle that. But you have the ability, people managing finance have the ability to help people see opportunities that they didn't know existed. And when you start to do this, you're going to find it exhilarating, because instead of being the old-fashioned bank that charges people penalties and you're hard and difficult to deal with, folks, when you get outside of banking, it's just a reality that most people think bankers are mean and cruel. I'm sorry, I don't want to say that, but the reality is that's how people look at banks. We need to get away from that by doing things that they don't expect. So if you start offering a bonus, you don't have to send out 1,000 notices. You can send out a couple, see how it works. Maybe call them up personally on somebody with $300,000 and say, hey, we're not expecting you to do anything. We just want you to know we'll open the door for you to take an opportunity to collect a bonus. Now that bonus is good as of today. As you get closer to maturity, that's gonna diminish. But as interest rates go down, it could get bigger. As interest rates go up, it could get smaller. And in fact, we can set up a calculation for every depositor. And let me show you how that works. Here, you could go in and tell that depositor, go get the information out of your online banking, key in the maturity date, the current principal and interest. Let's say it's a $100,000 account and it's at 505 today. You can key it into our early withdrawal calculator, and it will tell you that we would be willing to pay you a $555.80 bonus. You could use this today or any day in the future once you decide you want to have a redeemable CD. And if you want, we'll send you the disclosure and you can just transfer it over to the redeemable. You would have the exact same structure if it goes to maturity. But if you want to make it a redeemable, we can transfer it over. You would have the ability to use this to be your calculator. So folks, this can have your website, this can link to your website. This can be your logo on here. And your finance team is setting that discount rate that we were talking about. So no one ever is going to redeem a certificate and finance is going to curse the day. They're going to say, well, great, we set the price and they said yes. And if they say yes, we're happy because maybe we're actually going to fund this at 420. We're going to get back that $100,000 and we can go fund it at 420 today instead of 472. But we're going to give them the spread between 505 and 472 in that bonus of $555. It's very simple. And ultimately, you can, as Matt, it's a good question. How do we get started? You can start small. You do not have to make a huge campaign until you experience it. You can experience it with 1 or 2 or 3 or however many customers you want, get their feedback, and then decide how broad to make it. And if you at some point want to say, hey, we're going to put it on the website, you could do like one of our clients has done years ago, 2011, folks, before the patent was granted. TS Bank in Trainer, Iowa, started offering what they call CD2, the second generation of CDs. The CD2 was designed to give depositors 2 options. You could hold to maturity, or you could run the numbers. And if you run the numbers using that little tool that I had in their website, if you were to click on their website, which down right here, it says self-service calculator. If you click on it, it will take you to their version of this. And it has their logo down here at the bottom. And you can key in actual CD2 accounts, these parameters in the boxes, and it will tell you how much bonus or fee there might be. If rates are going up, there's going to be a fee for early withdrawal. If rates are going down, there'll be a bonus for early withdrawal, typically. So their website is a good example of how to market. You don't have to do it exactly this way, but Matt, here's what they say. Some CDs have substantial penalties for early withdrawal. By the way, bankers, There was a time when we were literally required to use that terminology, substantial penalty for early withdrawal. Basically, the regulator said scare people. So we did. And then today, a lot of people go, I'm not going to put my money in a CD because I'm locking it away and I can't get access to it. But others claim no penalties. That's a terrible idea, bankers. You should not be using no penalty CDs because you're committed to the fixed rate to the term, but the depositor is not. They can pull out. So no penalty CDs. If you do it for short periods of time, not terrible, but you will not see a smart bank doing a long-term no penalty CD. Just a bad idea. But have you heard of a CD that pays you a bonus when you withdraw early? That's what we're talking about today. And we've been doing this since 2011. But because interest rates were so low for so long, it didn't make sense to come out when we introduced this to you all, when we introduced Core CD. It would have seemed like trivia to talk about, someday, somewhere, you might want to pay a bonus. No, we didn't want to pay bonuses. We just wanted to get more deposits at cheap rates. Now that rates have gotten expensive and dropped down, this is prime time. I will also tell you that we had a conversation with Gene Ludwig. Gene was the former comptroller of the currency. I met him years ago when I was a banker. He came to Omaha, Nebraska, and we met. And recently I asked him, oh, by the way, he was the key person to structure reciprocal deposits. IntraFi, or Promontory Interfinancial, created reciprocal deposits when most of us in banking thought that's impossible. Nobody's going to let your FDIC insurance cover somebody else's FDIC insured deposit, but they got it done regulatorily. I asked him about the redeemable, and he wanted to know one simple question: how much you planning to charge? And when I told him a very modest fee, he said, this is going to be contagious because it has a value proposition that's good for everybody involved. Everyone's a winner. And it's so rare, bankers. It's so rare to find something where everybody's a winner. Usually, for someone to win, someone has to lose. That's the zero-sum game mentality that we have in financial institutions. But when rates change, our CD2, the next generation, gives you options, including a bonus when you withdraw early and rates have declined. CD2 is the same as the traditional CD, except without the standard early withdrawal penalty. So it's a very powerful thing. We're super pumped about doing it. And I will stop and see if any other questions have come in.
We did have a follow-up question, Neil, on your statement about this is not about moving money out of the bank. It's about actually bringing in more money, and how that topic overlaps with retention, so that they're going to be withdrawing. Then what kind of a situation does that create for the institution?
So all of you use limited edition savings. If they did want to withdraw from this account, they can withdraw just like they would any other maturing CD. But as I said, they are not going to say, see you, we're never coming back. You will experience the benefit of being the hero of the story. And you can use limited edition savings for an early withdrawal as long as they've had it with you at least, say, 5 months. You can do whatever you would otherwise do in the Core CD toolkit with companion accounts, all of those other things. But quite honestly, there's no deception going on here. We actually even say, here is the rate of interest you would have to have, 472. If you take the bonus, reinvest someplace, you got to have 472 to get back to where you would have $109,066.71 at maturity. It's not about giving them a windfall that somehow or another they arbitrage the bank or take advantage of the bank. We are actually giving them an option that's positive for them, positive for us, but only positive for them if they need the money, want the money for some reason, have alternative plans, or simply want to know that you really care about what they're doing, because they're not going to run the numbers like we are. But we actually share this 472 with them. So if they said, well, what rate would I have to end up in the same spot? We disclose it. It's 472. If you can't get 472, we wouldn't advise you to take it out early. We just want you to know you could. Now, with every other penalty, that number instead of 472 is going to probably be 6, 7, 8% if they take your penalty and have to reinvest it. So it just makes no sense to charge them a penalty when you would actually benefit from early withdrawal. I hope I answered that question properly. Other questions?
We did have one more, Neil. Yeah. Just on the topic of marketing it, you showed an example of, say, a bank took that step and was already introducing their depositors to redemption on the servicing side, and then they were beginning to offer it as a project. They're originating from the website. What would that look like?
Yeah. So what we would do there is it would be an origination that fits right into your customized certificates. We wouldn't originate, we typically wouldn't originate a standard CD or a board rate or a base CD rate with a redeemable, because the redeemable discount rate is probably going to be higher than your standard renewal rate. But if they want a redeemable and they negotiate with you, then you would give them a redeemable rate that's comparable to your customized CD rate. And you're willing and able to give them a customized rate, you could give them a redeemable rate. If you run a promotion, that's what you're going to promote, the CD, and you would have 2 promotions going simultaneously. Here's your 9-month CD promotion. Here's your 9-month redeemable CD promotion. And you would identify the features are all the exact same except for the bonus. And I'm not even talking about bonus dollars, but the bonus features, the extra benefits of daily redemption, calculation, withdraw any amount at redemption value, and the returns are always equal or better than the traditional CD in early withdrawal. So you can pick a savings account if you want a good rate and liquidity, or you can pick a CD if you want a little bit higher rate and lock in your account. But if you want the combination of better rate and you may want access to the money, grow the CD faster without locking up the funds. So this is how TS Bank has put it out there. And for all of you on the call, except TS Bank, you have never heard of this before. So if anyone wants to know, well, tell me how many clients you have using this. Well, we have one. Not because any of you rejected it, because we didn't even initiate it. You didn't even know it existed until 2025. So please don't take the fact that we only have one as somehow the market doesn't want it, or there's been bad experience or anything like that. We just didn't want to pull out our best in the toolkit when nobody cared. So you didn't hear us market this. You didn't hear. I've been working on this for 20 years, but you didn't hear me talk about it. We did produce some articles on it, as we showed before. And if you go to our Redeemable website, you're going to see that there are articles. But we didn't sell it as an idea for our client base. We simply waited until the time was right. So here are various articles: the Financial Brand, CU Insight, Bank Beat. This one's an interesting one, Matt and team. Iowa Bank offers CD that pays rewards for early cash outs. Notice the date, December 9th, 2011. 2011. So 14 years ago, this thing was in place, 13 at least. So just different things. We got on the national news with this because it was patented and it was in the patent process at that time. There is a patent on this. You can go see the patent if you go to Redeemable and go down here towards the bottom. You're going to see the U.S. patent right here. So if you do this and competitors in your market do it without subscribing to us, they will get a notice from our attorney to cease and desist, that they are not eligible for this. And you can see that the date of the patent was August of 13. The patent was filed in June of 12.
Neil, we did have a question. So the bonus, is it reported to the IRS as interest?
Yes, absolutely. That's a great question. If they held, in theory, if they hold a CD or any instrument over 12 months, and they get a gain on sale, that it could be capital gains. That's a possibility, but because this is novel, it's never been done before, we are going to give them a 1099 that shows the total interest paid this year, which will be whatever they would have accrued, and the early withdrawal bonus will be added as interest. You know, if you charge them a penalty, they get to deduct that on their income tax. In this case, you're paying them a bonus. They add that to their interest, and it would be part of the interest paid to them at the time of early withdrawal. Good stuff. Keep it coming. I know from just looking at the list, there are a lot of bright bankers on this call. So what are we thinking, folks? This is the time for you to chime in, ask questions. How would you implement this? What would it look like? I'm trying to answer those questions, but I want to know specifically what you're thinking as you think about this. Matt, are you seeing fresh questions?
I had a question to ask you just based on my background. So one thing that we saw when rates were rising drastically from near zero was that the penalties were marked to the interest on the CD. And so you had CDs with penalties that acted nearly like no penalty CDs.
Yeah.
And so could you just talk about penalty right sizing? We want to drop this idea of the penalty, but isn't that the second thing in the wings here, that the penalty right now is punishing the banks depending on where we are in the rate cycle?
So yeah, so let me use this little calculator, which is part of the handouts that you're getting. Let's say the interest rate is 1 and it's an annual compound. So if the interest rate was 1% on a certificate and you had a year to go with that certificate and the penalty was 6 months, $500 of interest, half a year, then if they cashed it out early, took their penalty, here, let's get rid of the accrued interest. So bankers, if you are sitting there with an account, $100,000, no interest, 1% interest rate, a 6 month penalty, that's $500 penalty. They would only need a 151 rate for the remaining year to cover that penalty. And you could even charge 12 months, 18 months. Folks, this is what you lived through holding your breath as interest rates went from 1/4 to 550. Fortunately, most of you didn't have a lot of refinancing, although there was some. But this simple calculator would tell a depositor, hey, if you can get better than 254 on the remaining term of 12 months, you should just cash out and take that $1,500 penalty. What we're doing with the redeemable is we're saying, structure the redeemable so you get a fair penalty, and then fortify your traditional penalty to make it a percentage of the amount withdrawn. Because you can see here, this would be 1.5% of the amount withdrawn. Maybe it should be 3%. Maybe it should be $3,000 or 36 months of interest in order to make sure that they need at least a 412 yield. If they're going to take the money that you thought was contracted at 1% for the next year, if they're going to take that and run, you got to have a penalty of about $3,000 today to protect your bank from somebody saying, well, gosh, I can just break that contract and do better. So there's a tension here of kind of Goldilocks, Matt. The Goldilocks is, with penalties, we're setting the penalty and then we're just hoping it works out. With the redeemable, we every day get to price the penalty. With the traditional CD, you're saying, I don't know, why don't we do 12 months of interest or 90 days of interest? Or, folks, that's dangerous. So what we do instead is we do the redeemable, and then we set a truly substantial penalty for early withdrawal, and then we make it the cap for the redeemable. So don't just say, oh, we do 90 days of interest. If you're still doing 90 days of interest, as rates move up and down, you're unnecessarily vulnerable.
Thank you, Neil. And that concludes the Q&A we have.
Okay. So let me wrap up then with this. We've gone through how each of you has an analysis like this that we want to deliver to your finance team. We know that there are some of you who are going to naturally be more interested than others. We understand that. In other words, everyone who has a more expensive portfolio is probably going to be more interested. So about half of you are going, wow, our portfolio yield is still over 4. Some of you, the portfolio yield is under 4, but even the portfolio yield doesn't tell us. It's the individual. It's kind of like, I can drown in a river that averages 6 inches of water, because some places might have 12 feet of water, and I can drown there. And the same thing is true here. You can create, even though you may have an overall low cost of funds, you may have a few accounts that qualify for a bonus. There's none of you, 0 of you, who wouldn't have some accounts that would qualify for a bonus. But maybe there's just such a limited number, like 21 or 24, and maybe it's a small project. No big deal. But maybe you have a project where you have 3,000 that would qualify. Okay, let's take it a bite size at a time, and let's walk before we run. And what we want to do with you is help you understand how to run the numbers. You should meet with me to do that. And then if you're interested, we do a very simple core CD agreement addendum. So we would license you to use this product. Some of you, a few of you, negotiated at the time that you structure the core CD that you would get not only the core CD that we have today, but the core CD premium packages. There are not very many of you, only a couple of you have that. If you have that, we are happy to honor that, and you can start doing redeemable CDs this afternoon. But if you haven't, you need to be licensed. And the license agreement is very brief. It's just going to tell you that, hey, we need an initial payment to get you started, and we need a certain number of dollars. This is not going to be a big number compared to your core CD package. It's going to be a fraction of your core CD package system. Now, that's very different than people who come in without core CD. I will tell you that for people who don't use core CD, but they want to get on the redeemable, we plan to charge 1 basis point. So for every $100,000 deal, we want $10. Your cost is going to be significantly less than that. And we want to honor the fact that you have been a core CD client. So you're getting preferred pricing, and it'll be fixed. It will not be based upon the volume, because we know you already have a relationship with us, and we're not trying to charge you on every new CD. We're not going to track it that way. But for all the people who license just the redeemable CD, they will be required to pay a royalty based upon every new account that they open or use a redemption process for. So we hope you find that advantageous. I'm telling you that as our clients, that's a benefit that you're getting in this new realm of 2025 and the dynamics of long-term savings. We want you to feel the benefit of a slight increase in the overall premium that you're paying to subscribe to Core CD for this premium service. It's going to be around 35 to 40% of the amount. So if you're paying us X, you can get an exact quote from me, but it's probably going to be about 40% of your Core CD package, a monthly system subscription price that would be in the would be the addendum to use this, and you would be able to use it no matter how much volume you got. Let's say you ended up with $400 million of redeemable. We would just be charging you whatever that fixed rate was in the Core CD premium addendum. So we think that's a great advantage for being a Core CD client. Okay, that may have sparked a couple more questions. I'm curious if anybody else has brought up a question, Matt.
No new ones at this point.
Okay. All right. Well, we're finishing on time. I am curious. You can go back to the question, and if there's anyone on the call, let's see here. Yeah. Okay. If there's anyone on the call that thinks that they might have interest, you don't need to report anything in the question area. But what I would like is a response. Did you learn anything? And something that you didn't already know as we did this presentation. I'm sure hopeful that I met that test, but does anybody want to respond with, did we learn anything? And I'm looking for responses. Or was this just old news for you because you've been watching all the constant contact messages we sent out and all the different articles that we sent out? But folks, this 2025, if we get Marcus, Synchrony, or Ally to do this, it won't be an option. If once the market starts to roll with this, you've seen it in other things, it changes the market. And that's what we think could happen here, is that CDs will never look like they used to look years ago. They will no longer be grandpa's thing. They're going to be real investment alternatives. I'm going to leave you with this. I had a banker on LinkedIn say to myself, or say in the LinkedIn, hey, I don't think you should change CDs because CD customers know what they're getting. He said, I'm not a CD investor. I would never invest in CDs, but you shouldn't change them. And I just looked at that and I thought, are you kidding me? You're telling me that you're an investor who's informed and intelligent, and you would never invest in CDs because you don't think they're a good investment with the early withdrawal penalty structure, but you don't think we should change them. Talk about an industry that is stuck in decades old thinking. Folks, AI is going to change your world. It's going to rock your world because we're going to get AI agents as financial planners. The idea that financial planning is limited to stocks and bonds and insurance is changing because the marginal cost to an AI agent of adding in a recommendation about where to move your banking services is zero. I can go to Perplexity or ChatGPT and I can ask it all sorts of questions about managing money, and it has no hesitation about telling me what to do. And it will not hesitate to tell people to move from that credit union or bank to these choices that have better products and processes. How are you going to get on that list? The Redeemable CD is how you get on that list. Thank you so much for your time and energy today. This is recorded. You will get access to the recording. And I would love to have you send me specifically, email me at neil@thecorepoint.com, any thoughts, and they can be the whole spectrum. I'm not expecting you to just praise this. I want to know working knowledge of what you think is going to work, what the challenges are, the whole strengths, weaknesses, opportunities, and threats. Matt, thank you for hosting today. Thank you, all of you, for being clients of ours. We love the fact that we get to work with some of the best and brightest financial industry experts in the industry. Thank you for being our clients. Make it a great day.
Thanks, everyone. Just a reminder, we will be sending the materials to you next week at the email you provided in registration. Please let Neil or I know if you'd like a report on your institution for this opportunity. So thanks very much and have a great day.